Welcome to your complete guide to disability insurance in residency and beyond. If you're watching this, I assume you just matched to a Canadian residency program, so first of all, let me just say congratulations. You've been working so hard for the last 8 to 10, maybe even 12 years of your life, and you are about to see the fruits of your labor. That being said, I remember when I was in my graduating year of medical school, literally right after the CaRMS match, we got bombarded by a bunch of independent insurance brokers trying to convince us that their policy was the one to go with. Now, being the overly analytical med student I probably sat down with about 5 to 10 different firms and really grilled them on the differences between OMA and RBC's policy so I could see for myself if it was really worth forking out that extra cash to go for the RBC. To save you guys the hours and hours of research that I had to put in to really wrap my head around this foreign world of disability insurance and finance more generally, I've decided to make this video with the objective that by the time you're done watching, you should feel confident that you have the knowledge you need to make the most objective, rational decision about which disability insurance policy will work best for your personal, financial, and life situation. So in today's video, we'll be going over the different life situations that you don't actually need disability insurance for. I'll go over some statistics to help you understand the risk that you're actually covering yourself against when signing yourself up to pay these monthly premiums to those slimy insurance companies. We'll be going over the differences between RBC, OMA, and PARO in terms of their different pros and cons, as well as going over the mental health clause of RBC's contract more specifically. I'll try to answer the question of how much disability insurance you should actually buy at this stage of your career, as well as going over the different riders that you'll probably want to add on to your base policy. Finally, we'll tie all these different concepts together with a case study that compares the cumulative amount of lifetime insurance premiums paid to either RBC or OMA so that an average medical student in your situation can come to a logical, actionable conclusion about the best course of action for who to sign their disability insurance policy with. If that sounds like something you're interested in, do stay a while. I'd really appreciate if you'd hit that subscribe button down below. It helps to ensure I'm still able to help keep putting out this helpful content, and it's free, costs you nothing unlike your monthly premiums. But without any further ado, let's get started in 3, 2, 1. Yeah. Okay, so full disclosure, I'm not associated with OMA, RBC, Sun Life, or any other insurance firm or brokerage for that matter. I'm not here to sell you on disability insurance, but I do think it's something that most people in our shoes need. That being said, the two life situations in my head at least that you don't need disability insurance for are A, if you are financially independent, or B, if, God forbid, you were to suffer a permanent life-altering disability that inhibited your ability to work and earn an income. Your family or your parents would still continue to support you financially until the end of your life expectancy. Now, while the family support criteria is relatively straightforward, financial independence has a very specific meaning in the world of personal finance. And no, it's unfortunately not just the point at which you're non-reliant on someone else to pay your bills. In the world of personal finance, financial independence actually means that you've accumulated enough wealth that you'd be able to pay for your living expenses until the rest of your life expectancy has passed and you eventually pass away without having to continue to work to earn an income. So for the rest of us mere mortals, disability insurance is probably something worth having. That being said, I do still have colleagues that chose to go into residency uninsured. But instead of telling you why I personally don't think that was the greatest idea, I think it'd be more fruitful to show you some statistics so you can actually get a sense of the risks that you're insuring yourself against here, so you can see for yourself if that's something that you think that you need to be worried about moving forward. According to Statistics Canada, there's approximately a 33% chance of your average working age Canadian becoming disabled before the age of 65. Now, in medicine, if there was a 33% chance that a bad outcome would happen, we would probably do something about it, or at the very least, monitor the situation very, very closely. Now, I think that's worth mentioning because it doesn't take a doctor to recognize that on average, these insurance companies are probably going to be generating a profit. That being said, I do believe the financial consequences of getting permanently disabled are probably devastating enough to be worth justifying a small loss to protect yourself against a devastating outcome. And if that wasn't enough to sway you, here are some statistics on the most common forms of disability. Now, this may or may not come as a surprise to you, but of course the most common causes of disability are mental health concerns, and even more so during residency. If you're thinking that PARO's disability insurance coverage is going to be good enough for your life situation, that may in fact be the case if you know with 100% certainty that you're going to be pursuing a salaried academic appointment with built-in disability insurance coverage. That might actually work for you. However, given that these academic appointments are limited and many physicians actually choose actively to pursue community placements over academic positions, I do think it's worth knowing about the different coverage options that exist. The most common question that comes up is PARO's built-in disability insurance coverage good enough? The thinking goes that it's already included in our union dues, and if we needed coverage as a staff, we could always purchase more then. In short, even though I'm usually all for saving money, I do unfortunately think the answer to this question is no, for two main reasons. The first is based on PARO's definition of disability. We'll get into the different definitions of disability under the riders section of this video, but for now, to keep things simple, there are three main definitions that you need to know: own occupation, regular occupation, and any occupation. Once again, I will go into this in greater depth under the rider section, but to keep things simple for now and so that there's not sort of 10 different concepts floating around at once, I want you guys to just trust me when I say that any occupation is generally not accepted as reasonable coverage for physicians. If you're interested, you can jump forward in the video and come back, but for now, I'll ask you guys to just take my word for it. Essentially, under PARO, after becoming disabled, you'd have salary continuation for 26 weeks or until the end of the academic year, whichever is shorter, followed by a year of disability coverage under the regular occupation definition of disability. Unfortunately, after those 12 months are up, you would have your definition of disability converted to an any occupation definition of disability. And given that you're trusting me when I say that any occupation is not reasonable coverage for MDs, you can see that the PARO's disability insurance coverage policy is not the greatest for any situation that would leave you disabled for longer than a year and a half. Even if you're willing to accept that risk during residency, premiums do go up each year as you age, and you can never be sure that you won't develop a new health problem in the next 2 to 5 years. So it's often better to actually lock in those lower premiums while you're still young and healthy and they won't force you to do a full medical examination than it is to save a little bit of money in the short term and essentially pay higher premiums for the rest of your life. Alright, so what's the deal with OMA versus RBC? Is it really worth forking out that extra cash to pay for the individual RBC policy? Or could it be that those greedy insurance brokers just want your commission? Truth be told, I wish I could give you guys a straightforward answer that would work for all possible circumstances, because that's kind of what I wanted someone to do for me when I was in your shoes. Unfortunately, no one is actually as invested in your own personal well-being as you, so the best way to come to an objective decision about the best policy for your own life situation is really just to understand the differences between these two policies inside and out. If you're curious, I personally went with the OMA level rate, but that being said, you may not have the same risk tolerance and and personal priorities as me. So let's get into the differences between these two policies and help you get on your way to making the most informed decision with regards to disability insurance. Generally speaking, RBC is going to be more expensive than OMA for the exact same disability insurance contract with all the same riders. The reason for this, of course, is that RBC's for-profit contract is individual, whereas OMA's non-for-profit contract is group. Essentially, when you sign with RBC, you are locked in for life because it's an individual policy, which means that they can't change the premiums on you and they can't change the terms of the contract. In contrast, you save a little bit of money by going with the group. However, the terms and the premiums can theoretically fluctuate over time, either for better or for worse within the group contract, depending on the amount of physicians claiming disability in any given year. For example, if a global pandemic causes a bunch of doctors to burn out and go on disability like they did in 2021, this could put strain on the group plan, which will force OMA to increase their premiums in order to continue providing coverage like they did have to do in 2021. The converse can also be said if the next generation of doctors pushes for a better work-life balance and thus has a lower overall rate of claiming disability. That might mean that future premiums may in fact decrease relative to the rates they have today. It's impossible to predict what's going to happen in the future, but this theoretical risk of fluctuation is why some people might actually just feel more comfortable going with RBC's individual policy so they don't have to think about what's going to happen next. I do think though that it is worth noting that even despite the recent increase in OMA's premiums, they still remain cheaper than RBC for most cases. And you do have to count the fact that even if OMA does choose to increase their premiums in the future, which they may, they would have to increase it to an amount that would offset the cost savings that you would have saved by going with the cheaper plan earlier on in your career. Finally, given that mental health is the most common cause of disability, especially during residency, it's worth knowing that RBC's contract has a mental health clause, which means that for the first few years that you signed up for this policy, you may or may not be able to claim disability for anything related to your previous diagnoses. One of the reasons I went with OMA instead of RBC is that I know that in essentially every other area of traditional finance, risk is historically rewarded over the long term. Stocks outperform bonds, variable mortgages outperform fixed, and cryptocurrencies, well, let's not open that can of worms. Essentially, I was betting by signing up for the OMA's policy that even if rates were to increase in the future, they would not increase to the point that they would offset the cost savings that I had saved by going with the cheaper plan earlier in my career. That being said, I don't know the future and I very well could be wrong, so please don't just do what I did without fully understanding the risk for yourself. In fact, I do think that going with RBC is a reasonable option as long as you understand why you're paying more for it. As a minimum, I would recommend purchasing enough disability insurance to save for retirement and cover your basic monthly expenses. According to the 50-30-20 rule of personal finance, 50% of your after-tax income should go to your needs, 30% to your wants, and 20% should be for savings. So if we follow this rule through, then we would say that the minimum amount of disability insurance coverage that you should purchase is approximately 70% of your residency salary. That being said, as doctors, we can actually reasonably predict with good certainty that at the end of residency, our salaries will double, triple, or even quadruple. And so the approach that most of us took was to purchase the maximum amount of disability insurance coverage that we could while we were still young and healthy. I think that's a reasonable approach to take because it's sometimes better to lock in those cheaper premiums while we're younger than it is to wait till we're older and have to pay more for the same coverage at the end of residency. Personally, I would recommend adding on the cost of living adjustment, the guaranteed insurability benefit / future income option depending on which contract you're going with, a 90-day elimination period, and if you're in a procedural based specialty, then you can consider adding own occupation. Cost of living adjustment is particularly important when you're young because it will essentially increase your disability payouts each year based on the consumer price index, which of course is a measure of inflation. So to give you guys an example of how important this would be when you're young, assume, once again, God forbid, you were to get disabled tomorrow. By 30 years from now, your $4,000 disability payouts would be worth $1,907, assuming a 2.5 rate of inflation. So it's really important that, when you're young, you get the cost of living adjustment. And once you start to get older and get closer to financial independence, you can reevaluate the need for this rider because, once again, the closer you are to financial independence, the less likely you are to be impacted by that long span of inflation that compounds over years and years and years. The guaranteed insurability benefit / future income option allows you to increase your coverage in a future year without the need for a medical. And once again, this is particularly important because as residents, we can predict that when we graduate from residency, our salaries will increase, which will increase our needs for disability insurance coverage, and thus it would be wise to get this rider so that we don't have to go through the whole medical process. God forbid if you were to get diagnosed with a medical condition in the next 2 to 5 years. A 90-day elimination period essentially just means that once your application for disability is accepted, you will have to wait 90 days prior to your disability insurance payouts kicking in. Essentially, you can opt for shorter elimination periods, but of course these elimination periods do come at an extra cost. Additionally, I do think it's worth noting that the rules of traditional finance suggest that we should have 3 months worth of living expenses either stored away in cash or readily accessible low-cost borrowing options like a line of credit anyways, and so this sort of just goes hand in hand with the rest of your personal financial health, in my opinion. Finally, let's talk about the definition of disability, which is probably one of the most misunderstood concepts in all of insurance. Remember that there are 3 definitions of disability. You have any occupation, regular occupation, and own occupation. Any occupation doesn't literally mean like any occupation that could possibly exist. So no, the insurance company isn't going to force you into a low-skill minimum wage job like operating a cash register. Under any occupation, you are defined as disabled if you're unable to perform the essential duties of any occupation for which you're reasonably suited given your education, training, and experience. Let's take the example of a surgeon who loses his hand in an accident, which is actually a pretty unlikely outcome, but it does help illustrate the point. So under the any occupation definition of disability, the insurance company could deny the surgeon's claim based on the fact that there are actually probably a lot of surgeons that could qualify for full-time teaching positions at a university, even though they pay substantially less. Regular occupation means that you're considered disabled if you're no longer able to perform the essential duties of your regular occupation and you're not employed in any gainful way in any other occupation. So carrying forward the example of the surgeon who lost his hand in an accident, the loss of the hand would automatically qualify that surgeon for disability insurance because without his hand he can no longer perform surgery, which was his regular occupation, even though he may still be able to teach. The catch here, and where it gets a little bit tricky between regular and own occupation, is that if that surgeon then chose to go back as a professor for the university and teach medicine, they would no longer qualify as disabled because he is choosing to then use his skills to seek gainful employment in another occupation, thus disqualifying him from receiving disability insurance benefits under the regular occupation definition of disability. I know, it's kind of convoluted, but it'll make more sense when you contrast regular occupation with own occupation. Finally, own occupation, the rider that every insurance broker is going to try and sell you on, but you probably don't need. To be fair, it is the most generous of all the definitions of disability, but of course it comes at an extra monthly cost. Under the own occupation definition of disability, you're considered disabled by the same criteria as a regular occupation. The only difference is that they remove that final clause from the regular occupation that prevents you from working in another capacity in order to qualify as disabled. So going back to the example of the surgeon who lost his hand in a car accident, if that surgeon continued to teach at a university under the own occupation definition of disability, they would still be qualified to receive their disability insurance payouts in addition to the salary that they drew from the university, essentially allowing them to double dip, because even though they're gainfully employed in another occupation or another role, they're still technically considered disabled because they're not working in their own occupation. So just to reiterate that one more time, under the regular occupation, the surgeon who lost their hand in the car accident would be considered disabled if they chose to abstain from teaching, whereas under own occupation, you can still teach and draw your salary from the university and qualify for disability insurance payouts, essentially allowing you to double dip and make, maybe even more than you would have if you were just the surgeon. Kind of funny that it works that way, but essentially I hope that makes a little bit more sense after I explained it and contrasted it. But that is the difference between any occupation, regular occupation, and own occupation. In my opinion, I really only think that primarily procedural based specialties should consider own occupation, because when it comes to physical disabilities impacting one's ability to perform their work, the cutoff there is quite clear. It's quite concrete. There's not a whole lot of gray area to that. However, for cognitive-based specialties like psychiatry, medicine, or pediatrics, the cutoff to me is a little bit less clear in terms of a form of disability that would leave you unable to perform your actual duties but still able to teach or work in any type of gainful employment that MDs often work in. That being said, if there's something that you guys can think of that I'm not thinking of, please do feel free to leave a comment below so that all of our peers can benefit from the discussion. All in all, I would say that regular occupation is probably sufficient for most specialties in medicine. If you're in a procedure-based specialty, you can consider adding own occupation if you know for sure that you would like to continue working in some other role, God forbid if you were to become physically disabled, and you would still like to receive your full disability payouts. Alright, so now that you know the basics of disability insurance, let's head on over to my desk where I'll walk you through a case that ties together all these different concepts and walks you through the thought process that I was going through when I was making these cost projections last year to try and decide which disability insurance policy was going to be best for me. Alright, so these are my cost projections comparing the RBC level rate with the OMA step rate, as well as the OMA level rate with the RBC level rate. There are other versions of this calculator available on the internet, but the reason that I chose to make my own was that none of the ones that I was able to find actually adjusted for the interest rate on our lines of credit, which here is labeled as the estimated annual rate of return. At that time it was 2.2%. Today I would probably use somewhere between 3 and 5%, given that interest rates are rising and will likely continue to rise for the next year and a bit. The reason why it's important to adjust for the interest rates on a line of credit is that presumably the difference in premiums that you would save by going with the cheaper policy would then go on to your line of credit, and thus you would save interest from your line of credit, essentially, because you're paying down principal, so you're paying less interest on that line of credit. And really what we care about is not just the difference in absolute cost between the two policies, but the difference in the bottom line that it's going to make to your own personal finances. And that's why we adjust for the risk-free interest rate that we get by paying down the debt on our line of credit. Of course, if you don't have debt or if you don't have anything on your line of credit, then you can just make this zero and it would still work out to the same. If you're interested, the calculations in how I derive this are to the right of column J. You can sort of double click on the formulas or double click on the cells and see how the formulas were derived. But really, from a big picture perspective, you can kind of ignore everything to the right of column J and still get the same idea. Essentially, everything in green is a variable field. So of course here comparing $3,000 of coverage to $3,000 of coverage with all the same riders, regular occupation, COLA, GIB, because we want to be comparing apples to apples here, not apples to oranges. And you can just insert the amount of benefit you get from your broker once you get a quote from them, as well as the monthly cost of that amount of benefit there. Of course, RBC's first year is free, which is why this is blank, and the annual cost here in these white cells is labeled, but really what we care about is the cumulative cost over our entire careers, which is why that's highlighted in yellow, and that's what's actually plotted here on the graph that'll adjust once you plug in those numbers into the variable fields. And of course, with the OMA, this is adjusted for the interest savings that you get year over year by paying down your line of credit, which then would be reflected in the OMA step rate, less cumulative interest savings. And if you're interested in just the raw amount of money that you'd be paying to the insurance company, that's just to the left here in white. So with all that being said, we can move over to the graph here. So once again, comparing this for $3,000 worth of coverage, OMA step rate versus RBC level rate for a 24-year-old non-smoking male. You can see here that the RBC is in blue, OMA is in orange, and what you'll see is that the point of intersection where the OMA step rate actually starts becoming more expensive than the RBC level rate is around age 38. Now, how do we make sense of this? So essentially, for my own personal situation, I don't think that it's reasonable for me to expect that I would be financially independent by age 38. I think it's actually more reasonable to say like around 55 or 60 that I'd be financially independent. And once again, that's based on my own projections, but that would be a whole other video in itself, which I'm happy to go over if you guys are interested. Essentially, the fact that the point of intersection is before my predicted age of financial independence, the OMA step rate does not compete with the RBC level rate, not in this situation at least. For your situation may be different because these premiums depend on your age, your sex, smoking status, and a bunch of other factors that they'll have you punch into their calculators. But yeah, you know, given that this point of intersection is so far before my predicted age of financial independence, RBC wins in this situation hands down. Now, that being said, if you guys recall, I didn't actually end up going with RBC. I went with the OMA level rate, and that would be based on these calculations. Once again, all the same sort of setup here. You got your OMA level rate less cumulative interest savings, so minus the cumulative interest savings that you would get from paying down debt each year. And you can see here that actually the OMA level rate is a little bit more expensive for the first few years, and that's mostly because RBC is free for the first year. But then the point of intersection here is at age 27, after which OMA becomes cheaper than RBC from a cumulative perspective. And I even less so expect to be financially independent by age 27, which therefore means that based on all these assumptions, so once again, assuming that OMA's premiums don't increase, they stay the same or they decrease, then based on these conclusions, it would make logical sense, quote unquote, to go with the OMA level rate over the RBC level rate. The other thing I'd note here is that technically, even if they do increase, let's say they increase at age 40, you know, the premiums for OMA, they would have to increase to an amount that would cause another point of intersection where the cumulative cost over my career of the OMA level rate would be more expensive than the RBC's level rate. And that's sort of the bet I was making when I signed up for OMA, that even if there was an increase, it would not cause another point of intersection to make me sort of regret my decision. Let's hope that ends up being true, but sort of that's the risk that I was taking. So that's one way you can look at it. You can look at the point of intersection and see how far off of that is that compared to your predicted age of financial independence. And the other way you can look at it is, okay, well, over a 41-year career, how much am I actually saving? And so if we go here to age 65, you'll see that you know, the cumulative cost over that 41-year career that I'd be paying to the insurance company under the RBC's policy would be around 22K compared to around 18K in the case of OMA. So you could also make the argument that, hey, you know what, for $5,000 over a 41-year career, I'd rather just hedge my bets and go with RBC. That way I know that there's no risk of policy fluctuation, no risk of premiums increasing in the future. 5K over 40 years is not that significant. Of course, the numbers will vary based on what your exact quotes are. And so these numbers will be different for you, and you'll have to look at the absolute cost in your situation, not just mine, in order to come to a logical conclusion for yourself. But those are the two ways that I would go about thinking between the different policies, the RBC and the OMA. Once again, you can look at the point of intersection and see how far away of that or how far away that is from your predicted age of financial independence, which in itself is a whole other video and a whole other projection. Or you could look at the cumulative cost difference over however long your career is going to be and ask yourself, am I willing to pay those extra couple $1,000s for a little bit of guarantee that there's going to be no premium fluctuations in the future? Once again, OMA's premiums could go up, they could go down. You know, that's sort of the risk you're protecting yourself against by paying these higher premiums up front. Do share this with a friend if you found it helpful. As you guys probably already know, most of this channel is dedicated towards helping pre-medical students, but in the future I am looking to do more of these personal finance videos for residents and medical students. So if that sounds like something you're interested in, do hit the subscribe button. Once again, thank you guys so much for watching, and I will see you in the next video.